2.3%. The S&P giving up 22, going out at 1906, just a hair above that 1905 level that everyone's watching. The Russell 2000 off 1%. That does put the Russell now about 13% below its 52-week high. Let's bring in our panel. Robert Luna from SureVest Wealth Management, Bob Dahl from Nuveen Asset Management, our own Kayla Tausche, fast money trader Steve Grasso joining us off the floor in just a moment, and our Steve Leisman with some breaking news from Treasury Secretary Jack Lew. Steve, reassuring us all here?
No, the other way, Kelly. He's talking about global economic weakness, saying the global economy continues to underperform. This is the Treasury Secretary Jack Lew addressing the IMF meetings, the annual meeting, saying the euro area recovery has lagged other advanced economies, and he's saying that Europe should recalibrate its policies to address demand-side weakness, specifically structural reforms he mentions, also fiscal policy where it has some flexibility, he says. Also talking about China, says there's a risk that the risks to the Chinese economy have risen, and finally he says G7 and G20 countries should adhere to their exchange rate commitments. So a little concern on his part, Kelly, being expressed there that the weakness in the globe could reflect itself in exchange rate or currency wars that are out there. Finally, Kelly, we were talking, our friends over the CNBC Europe were talking to the French finance minister when the downgrade or the downgrade in the outlook happened from S&P, and he said that the problem, this was a Eurozone problem, not a French problem. And we're waiting for that tape to come in, but that's what our friends from CNBC Europe said. The French finance minister responded to the downgrade by S&P of the outlook for France from stable to negative.
Steve, thank you. Let's get everybody up to speed here and get some thoughts from the panel. We've had the outlook for the French economy downgraded by S&P just in the last hour. We now have these comments from Treasury Secretary Jack Lew warning about the weakness overseas, Bob. And we have the Dow selling off at the close here, and the S&P almost hitting its 200-day moving average.
Yeah, this has not been a fun week, no question about it. I'd say on the other side, we've got the manufacturing sector improving. We've got the employment numbers getting better. We've got a big tax cut in the form of energy price decline. So, look, I'm not saying the market shouldn't go down during this week. We've had some real issues. But remember, we're only down 4 or 5%. This is the fourth time this year we've had a decline of that magnitude. We've done a little more technical damage this time. It's going to take a little longer to come out, I think.
Robert, your perspective here, do you agree?
Yeah, I agree with Bob. I mean, it's, the tough thing, Kelly, is people are going to wake up on Saturday morning and look at the headlines down negative on the year. So it wouldn't surprise me at all if we see some more pressure in the markets Monday or Tuesday. But I think when you look at valuations, what's going to happen is people are moving a lot of money into cash right now, and the realization is cash still pays nothing. So when they start looking at the stocks that they own, and they see it, some of them, even though the market's only pulled back 5-6%, there's good stocks down 15-20% right now.
Oh, sure. And Kayla, we're heading right into the heart of financial earnings season as well. Should we be concerned about headline risk there?
Not necessarily. I think the third quarter, with some volatility starting to creep back into the market, was probably good for banks. We heard a lot of the CEOs talking at the Institute of International Finance conference today, talking about how consumer spending is picking up, lending is picking up, commercial loans especially, they're seeing strong demand, and that industry is well capitalized and is seeing a strong return to growth. But they all said a global recovery without Europe is not a recovery. So just because things are okay here in the U.S. doesn't mean that that people will be willing to put their money into global equities. One thing that I'm watching, Kelly, is today we got news that the ECB is going to announce the results of the European bank stress tests October 26th. It's a Sunday, but there are a lot of investors who are saying, okay, I'm not going to invest in financials until I see either I'm pleasantly surprised by how well capitalized Europe's banks are, or that is much worse than I expected, and there's a lot more work to do there.
And that's still a couple of weeks off. Steve Grasso is joining us now from the floor. Steve, and to the points that everybody here has made about the strength of the U.S. economy, look, would you have thought in the same week that jobless claims are at near historic lows that the S&P would be behaving this poorly?
No, and you also wouldn't have thought that this market has been somewhat bulletproof for the longest time, but technically it is breaking down, and you do see Europe slowing down. So obviously it's the perfect timing. It's a perfect storm for the market to sell off. And look at the S&P. Of course, we closed right at that 200-day, which is 1905 in the S&P cash. We've had 7 times where we've broken the 100-day moving average in the last year or so. and we haven't broke the 200-day in 2 years. So we need a clean break of that 200-day. This is not going to be enough to satisfy the market.
And yet it's sort of two different messages here, Steve. You and others watching the chart saying there's a lot of damage being done here. And meanwhile, the fundamentalists, the guys to my left, are saying, you know, frankly, there's not so much to be concerned about.
Well,
Am I hearing you right?
You're always, you know, I think the chips were the biggest thing that spooked the market today. If you look at it, they're a leading indicator. So we have to really proceed with caution from here. We have to hear what the companies say next week. September's usually the best month for chips, not the worst. So I think it could be a very telling week next week. But I would say lower versus higher.
I would argue the word volatility and liquidity go hand in hand. We have had a whoosh of liquidity for how many years now, and now we're in the process of the Fed taking that off the table. Through the tapering process, eventually rate normalization. Markets are not volatile when rates are zero and there's all kinds of liquidity. As liquidity gets withdrawn, we're going back to semi-normal volatility. What we experienced this week is not all that unusual unless your frame of reference is the last few years.
But if you're still saying it's a good thing, it's an opportunity, say for people who weren't in this market for the last move higher to get involved then, even though it's going to be more volatile?
You know, I wouldn't run out and buy them all. I guess you can't buy them tomorrow morning, Monday morning, but I would be dollar cost averaging in, believing the bull market's not over because the economy and earnings are doing a bit better.
Okay, hold that thought. Let's get another take on the markets here from Winnie Sun. She's joining us from Sun Group Wealth Partners, which sounds sunny. Winnie, is your outlook more positive here? What do you make of the damage that's been done to these markets this week?
Well, Kelly, Wednesday life was great. Thursday, not so much. Today, not so much either. This is one really moody and emotional market. But we think it's not the time to be panicky. But it's time to review your portfolio holdings. The Europe, Asia, this is all real concerns. Ebola is a big one. The S&P has nearly tripled in the last 5 years. So it didn't take that much for you to look really smart, but you want to be able to look back at this time and have something to show for it. So what we're saying is take some profit and hold some cash and be positioned to invest in times of weakness in these little mini corrections that we're seeing.
A question then, Winnie, for people this weekend, again, maybe reviewing their portfolios as you indicate, what should they do? I mean, where should they be shopping?
You know, we still like the story of tech long term. We think that if your time horizon is long, then you should be buying on weakness. See these corrections as an opportunity to build.
I would agree with that. I think cyclicals in general, assuming the economy and earnings are doing better, and I think there are lots of evidence to say that's the case, are the ones that will come up and out when this noise is over. Remember, January we're down 7%, April 4%, August 4%.
The comments from Microchip seriously to the extent to which they say, look, we think the industry cycle here is ending.
Well, ending, I think that's really strong. Maybe some of the stuff that they do individually, but there are other parts of technology that are doing brilliantly well. And there's still capital expenditures that are moving up in CapEx. There's still pent-up demand. So, look, we're not going to have a CapEx boom, but enough for the earnings of these companies to be better.
And Robert, what about you?
Yeah, and Kelly, I think if we were looking at a market that was really getting ready to collapse, which I think is what most individual investors are really worried about right now, is, hey, is this another 2008? And is it going to be a 5% correction, or is this going to be a 15 or 20% correction? When you look at companies like JW Nordstrom today up, Costco up today, Pepsi, there are some shining lights out there. So the high-end consumer is still in the market. I think there's still a lot of opportunity, but it's probably time to be a little bit selective in the stocks and not just go out and buy the broad-based index.
You also have the retailers that are strong too, because you're comping that year-over-year comp with the federal government shutdown. So a lot of those are going to look better on a year-over-year analysis versus anything else. So maybe you could see that pop going into year-end. And obviously, we're before midterm elections. Retail names probably do a little bit better. And then if you're hoping for that pop, Kelly, you're playing it after midterms, not before.
All right, we'll leave it right there with a thanks to everybody. Steve Leisman, was that you?
Well,
Want to get a
make
quick last word in here?
Very quick point. Not a dollar of liquidity from the Fed has been withdrawn. In fact, as we speak, the Fed is still adding. It will, I believe, next month as well. And for all of next year, I believe the entire amount, mostly the entire amount of the balance sheet is going to remain unchanged. So we're not going to be adding liquidity, but the notion that liquidity is being withdrawn, that's not the case right now.
Not right now, but you know, Steve, markets like to get ahead of what's coming.
But they're
so we'll
way
see if
ahead. If they're trading
changes.
on with liquidity being withdrawn, they're maybe more than a year ahead of that.
Understood. A good reminder, Steve, and thank you very much. We'll leave it there for now. And thanks, everybody. Stick around.